Okay, welcome back to chapter 11, and we are on part E, which is on page 6. I just have to close this window because the traffic's slow. We are on page 6. We are going to do impairment of assets. Now, in previous chapters, tangibles, we just talked about impairment of assets. We're actually going to learn the methods this time so that you have experience with these. The methods have different little twerks and stuff, but you'll be able to understand how it all fits together after we've done these. Okay. Under both IFRS and ASPE, assets have to be regularly checked for impairment or a decrease in value below carrying value. So IFRS requires assets be assessed each reporting period, and they use the rational entity impairment model. ASPE, just like earlier chapters, assets are assessed for impairment when changes in circumstances occur. So remember, we talked about a trigger event that the carrying value may not be recoverable. ASPE uses a different method. It's called the cost recovery impairment model. So when it's not possible to assess a single asset for impairment because it generates cash flows. With both of these methods, you have to use the cash flows that your asset is going to bring in. So you can't assess a single asset for impairment. So one machine generates cash flows only in combination with other assets. Then you identify the smallest group of assets that can be identified that generate cash flows independently from other assets. Okay? So if you had cash flows being generated, you had a room full of machines that's doing the same product and then another room full of machines doing another product. You can probably break it down each by product. Unless you've got millions of machines, then you might not. You might group them differently. Okay? This group is called a cash generating unit. The CGU, so one room of machines that makes, I can't even think of something like TVs, is tested for impairment using the same methods. Okay? So you can read more about the CGU in the text. It's just, you want to do each asset, but if you can't isolate the cash, calculate them coming in for just that asset, you've got to add more assets. Okay? Because you'll have sales on product X. So if you got 6 machines producing the same product, you can't do each one separately. You do. Okay? So let's start with IFRS. The rational entity impairment model, it compares the asset's carrying amount with its recoverable amount. Now, you have to figure out what the recoverable amount is first, so figure out that first. Don't worry, do an example. It's much easier once you see an example. The higher of its value in use and its fair value cost to sell. Where value in use is the present value of future cash flows expected to be derived from the asset's use and subsequent disposal. So you know how in managerial accounting, you take, let's say you're considering a new project. Right? You'd show all the cash flows coming in, all the cash flows going out, and you'd present value them all, right? To get the NPV. Same idea. Except it's just dealing with not a new project, but one group of assets. Now, impairment loss added to loss on impairment on the income statement unless the regression method is being used. In which case, as much as possible is debited to REI, and the rest to loss on impairment, because if you remember, revaluation surplus can't go to a debit balance. Now, the credit can be accumulated impairment loss. So if Wiley Plus has that in its chart of accounts, use that. In real life, you can asset itself. The key thing is you're consistent amongst all your assets. Again, if you're working, you're just taking over from someone, and you don't know what they use, look at last year. Okay, so we compare fair value list in use and the higher one becomes the recoverable amount. You compare that to the carrying amount. If the recoverable amount is bigger or equal, no impairment. If it's lower, then impairment. So if I tell you recoverable amount of your group of assets is 100,000, and on your books it says 300,000, well, recoverable means really what they're worth. That's not good, right? We have to impair, and we'll take the difference. Okay? So, as we briefly talked about in the other chapter about impairment, sometimes it can be recovered depending on the method. So, let's do on page 7. At the top, it talks about reversal. A portion of the impairment loss can be reversed in the future as long as the net asset is not increased in value to more than what its book value would have been had the original impairment not been recorded. Which, okay, that was a lot of words, you guys. Let's do an example. Makes more sense that way. So, example 3. Equipment with a carrying value, so on your books, 45,000, cost of 60 accumulated, depreciation of 15,000. It's being annually tested for impairment. And this is IFRS, because we're in the IFRS section. Okay, straight line is being used. Now, these are the pieces we needed. Value in use is given, and that would be the present value of future cash flows. The fair value less cost to sell, and sometimes they separate it out. They'll say the fair value is 45,000. The cost to sell is 5,000. So you'd have to subtract it yourself. Okay? Is 40,000. Record any necessary impairment. So, let's calculate our recoverable value first. Now, they said we had to compare two things. So look on your last page, and it said you compare the carrying amount with its recoverable amount. So we need to figure out what the recoverable value or amount is. And it's the higher of value in use and fair value less cost to sell. So VIU is value in use versus fair value less selling costs. Okay, so what did they tell us the value in use is? 47,500. Fair value less cost to sell, and sometimes you have to calculate it, is 40,000. Okay, which do we use? The higher one. So, our recoverable value is 47.5. So, now we're going to compare recoverable value. Compare recoverable value to CV. So we've got recoverable value and we've got carrying value. So the recoverable value is 47,500. What's our carrying value? 45,000. So the main thing is we don't want our books to overstate all the assets we have. We don't want it as too high. So the recoverable value is higher than the carrying value. So are we safe on our books? Yeah, we're not showing them too high. So no impairment needed. Because we are not overstating assets. So no impairment. So step 3, I'm going to find a pen. Step 3, No impairment entry necessary. Okay. Right, it's straightforward. This looks a lot better than the words. Let's do example 4. You know what? You should put it on pause and try to do this. You can't do the entry because you don't know. Well, you could look back and see what it says. But just try and figure out if there's impairment or not. So put it on pause and give it a shot. And then come back and I'm going to go through it. Okay, so statement as above with carrying value 45,000. 5 years in life. The value in use is 37.5 and fair value less cost to sell is 40. Record any necessary impairment. So hopefully you've done this. You got the recoverable value, value in use versus fair value less selling costs. Our value in use is 37,500. Fair value less selling costs is 40,000. So, which do I use? Highest. Okay. We're going to compare recoverable value to carrying value. So recoverable CV. Recoverable value is 40,000 and our carrying value 35,000. So what do you think? Are our books overstated? Yes. So there's a difference of 5,000. Our books are overstated. So impair by 5,000. The difference. Okay, so we need an entry. So, third is the entry. So we're going to debit impairment loss for 5,000. Bearing in mind, if using revaluation method for keeping track of our assets, you know, where we can write it up to fair value every 3 years or cyclically, we have to use revaluation surplus OCI if possible, and the rest to impairment loss. And just to remind you, remember this little account can't have a debit balance. Sorry, that's squashed in there. So remember from last chapter, it can't have a debit balance or debit balance. So you do it until it reaches 0 on the balance and then put loss. Now our credit is going to be accumulated loss on impairment. So again, if Wiley Plus has that, go ahead and use it. However, you can also use accumulated depreciation, or you can use equipment. And just so you know, this account is a contra asset subtracted from equipment. Okay? So, if Wiley Plus has these, well, it will have this for sure. But if it has this, use it. It probably does. And then these other two, just in real life, you can use it. Now, I want to draw your attention to one thing. Now that we've written this down, what's happened to the book value or the carrying value of this? This has gone down 5,000, right? We're going to decrease the carrying value by 5,000. So now we have a new carrying value of 45,000 minus 5,000 is 40,000. So we have a new depreciation calculation for the next year. Okay, so you just use the formula from last section, because there's been a change. Okay, it's probably knocked me off already, but I'll turn this off and go to a new video.